program. Joining us now, Charles White, Managing Director, Fixed Income Capital Markets at Stifel Financial Corp. Charles, good to see you again. Thanks for coming on.
Yeah, thank you. Hadn't seen you in a year. Hope you've been well.
Yes, sir. Absolutely. Hope you have as well, sir. So appreciate you coming on. I can't think of a more timely situation, right, to have a banking symposium and discuss all things finance and economics than the turbulent times we're living in right now.
Right. When we were planning this 6 months or so ago, we were trying to figure out what would be important about this time, and right now we've got a speaker in there who's spending all of his time, almost 45 minutes, on just that, on inflation, the economy, and how the banks cope with it and how the consumer's coping with it.
Yeah, so many dynamics, so many inputs, lots to process. Seems like, honestly, Charles, that makes the role of managers and management at these financial institutions a little bit more difficult than it was a short year ago, certainly more so than the prior 4 or 5 years.
Big time. For the last, really, a decade where the Fed and the other parts of the government have supported the economy and made money so easy, a lot of people have had a lot less difficult time. Banks are fairly efficient right now because rates have been so low, but this is a taxing time for management.
No
Absolutely.
doubt. Charles, how does Stifel work with the typical commercial bank?
Sure. We really have got, we're really more of a research and strategy-driven institution where what we try to do is have inside Stifel what amounts to be the equivalent of a very, very large bank treasury operation. So you can help them manage regulation, investment risk, interest rate risk, and anything else associated with the operation of the bank.
Yeah.
And really, that plus the market's movements and how to understand how they affect the banks is kind of our role.
Yeah.
And it changes every week, as you can imagine.
In a rising interest rate environment and also an inflationary environment, do they alter the target customers? Do they change the products they're trying to sell to the extent they can from a regulatory? How does it just change what they're selling and who they sell to, if at all?
That doesn't really change that much. Regulation will force a product change if there's a risk in the economy and whatnot. For instance, banks are capped for certain commercial real estate loans. They have limits from the regulators, and they get more scrutiny if they go above and things of that nature. But the structure, the products don't really change. The structure does. For instance, 30-year mortgages, right? I've got 3 kids. They all have 3% mortgages.
Yeah.
Never thought that would happen. Now the mortgage rates are 6.5 to 7. A lot more adjustable rate mortgages, which are in the 4 to 4.5% range, are being done. So, that will change the nature of the products and the structure, but the basics don't really change.
Okay, that's fair enough. What about the regulatory environment? It seems like we have a government here that's just bound and determined to inject more regulations into all of the industry sectors. The banking industry, of course, one of the most, if not the most regulated of all the industries in our country, honestly. How much is that impacting the operations of these commercial banks? And I know it costs them a whole lot of money to maintain compliance. Have we seen an uptick and an increase in their costs and just their risks in just maintaining compliance since we've kind of had a change in government's approach?
The watershed event for that was a little over a decade ago, right? It was 2008, 2009, where the expenses placed on the banks went up dramatically for compliance with a multitude of rules. The initiation of the Consumer Finance Protection Bureau did the same thing. Lately, in the last couple of years, that hadn't really changed much. That burden's been big, and it grew a bunch a decade ago. It hadn't changed much. If we see credit issues or credit problems, it'll ramp up again. But that's a very, very large expense of running a bank right now.
And to a great extent, it's passed on to consumers.
It is.
It has to be, or you can't maintain any sort of degree of cash flow and profitability.
Correct.
You've got armies of people
Yes.
do they not, that oversee all this?
Yes, I mean that's the biggest expense, right? Is you got to number one, hire the people, number two, make sure they're certified and experts in their area, because if they make a mistake, right, it's going to come back on the bank, and the clients want the banks to be well capitalized. Well, the way you're well capitalized is you have a lot of earnings and a lot of retained earnings, right? That's a cushion against any problems. So the banks have done a really pretty good job of managing that expense growth, but you're right, it comes at the expense of the service they give the clients.
I just don't think that so sometimes you got a situation where we've got a protection organization, a protective organization that was certainly established as such, that maybe it's actually costing us all more money at the end, not really protecting us, and it's a bit of a concern. What about the investment world itself right now? I mean, it's been we've seen a fairly robust market now for 10, 15 years with respect to availability of capital certainly from private equity and those who are able to make loans or invest in private companies that are able to do that outside the regulations of a typical commercial bank. Mm-hmm. Are we seeing a change in that, given the increase in interest rates? It changes their risk profiles. They're got to be change their selection of assets and their underwriting and so forth.
Sure. I mean, when you artificially held rates down like we've done, really on and off for 14 years. I mean, of course, during the pandemic, it reached its peak intensity, so to speak. That money becomes available. There's a lot more leverage in the system, and so the assets that are purchased by that leverage get inflated. Think about the housing market.
Yeah.
Go back to our 3% mortgages. The house prices that have taken place in the last 2 to 3 years could have never gotten to these levels without the subsidy of those mortgages.
Yeah.
And now that's going away, so those house prices, number one, can't go up anymore, or won't, or maybe in certain areas they do, but not many. And they're going to start to come back down.
Yeah.
The good news here is the housing market of today is not like the housing market of 2008, so that's not happening. But that's just a good example of how the value of the asset was artificially inflated by the availability and cost of money.
Yeah, and I wonder how those inputs may affect valuations. You got someone who's got a family business, for example, that's been building it up their entire lives, and now they're ready to exit perhaps, and they go to the market looking to sell that asset. How's that affecting valuations when you got the cost of money so high, and that maybe affects private equity's valuation of that asset when they come in and do a purchase?
Right. If you'll notice, you read articles about private equity, their returns have been incredible the last 3 years.
Yeah.
Well, the main reason is money's been so cheap, right? And so the asset values tend to be inflated by that. And so that's coming down now pretty good. Probably the lingering good news is we were talking about this earlier, there's about $2.5 trillion in excess cash in the economy versus what it would be without all of that, right? Not 2.5 over 2 years ago, but over what it would be today.
Okay.
And it's going to take a little while to burn that off.
Yeah.
And that's one of the reasons why the consumer is able to handle inflation like they are.
Okay.
But there'll come a time, right, where that gets burnt down and burn off, and that capital gets more expensive, and that valuation's got to come down.
Yeah, that makes total sense. But, I talk about this, and it's interesting your perspective on it, because that fuels and funds our innovation in this country. That's where it comes from. Well, I mean, without that, there's no innovation. You got to have money to do it, and that means somebody's got to take risk.
Yes.
Because the folks that come up with these ideas generally don't have the money to turn their ideas into reality, and that's where the investment community comes in.
Right. And that, really the non-monetary way to enable that, right, is to make it easier for the entrepreneur to get into business, stay in business, which means regulation, right, and to make him or her be in a position where they can keep more of what they earn.
Sure.
And so a normal interest rate environment coupled with a low tax and low regulation environment is really kind of peak prosperity.
Yeah.
Free money and high taxes and high regulation, to quote Animal House, there's no way to go through life, right?
I like that.
And it feels like the United States is going to make its way back to that.
Okay.
Maybe I wasn't old enough in 1980 or 81 to appreciate it, but that's kind of when the U.S. started to work its way back.
I was there.
Yeah.
Just graduated from college.
That's right. I mean, I didn't know anything around me, but it feels like we're making our way back there, but it's going to be kind of a difficult journey.
I got you. You care to handicap what the Fed's crystal ball looks like right now? Look in your crystal ball and handicap it.
Well,
about 30 seconds.
Yep, I'll do it real quick. Well, the Fed uses a guy named Nick Timiraos at the Wall Street Journal to tell us what they want us to know, right? And they've told us they're going to raise short-term rates by 75 basis points in November. Their next meeting is mid-December. That one's going to be tough because there's going to be something spilled between here and there.
Gotcha.
And is it bad enough to slow them down or not? I don't know.
Man, I don't either, but we shall see. Charles White, Managing Director, Fixed Income Capital Markets at Stifel Financial Corp. Thanks for coming on, Charles.
Yeah,
Appreciate
you got it. Enjoyed it. Good to see you again.
Middays, we'll be right back. We've got Gordon Fellows, President, Mississippi Bankers Association.